The most dangerous company for the investments for the year 2023 is what you get it from this video. At EQSIS, we recommend our clients not to invest in these list of companies. But this video gives you the step-by-step approach in how to find the dangerous company for investing. And in between, we are going to give you one bonus tip by which you get an idea how to find the best companies for a long-term investments as well. Stay tuned. Myself, Murugan. I'm a SEBI registered research analyst. Happy to present another fantastic video from EQSIS. Let's see how to find them. So we are going to use two major factors. One is the quality, the other one is the pricing. And we also going to consider size as a secondary factor just to make sure that we were able to look at the top list of companies so that we can see how we can really balance a portfolio. And if you look at the quality, we are using a metric called return on capital employed. So this may not be a standard way to look at from all the companies. And as in a special case, that return on capital employed may not be that applicable in terms of looking at the financial or a banking related companies. So otherwise, the return on capital employed is a fairly straightforward a quality metrics. We can use it. The other one is the pricing. So with respect to pricing, we are going to consider price to earning, which is widely accepted practices. And especially when we are looking at the large cap companies, fairly sizable companies, P ratio is a quite realistic measure what we can take. And these are the two factors we are taking in order to find the most dangerous companies to invest. So let's see how to find them. So we have to put it in this grid. If you look at this particular grid, it consists of the four quadrant. Whereas if you look at the first quadrant, it is going to get the list of companies matching a high quality business with a low pricing. In a way that this is one of the best list of companies which we wish to be part of it, because the quality of the business is so appealing, but the pricing is low. Am I right? So we wish to know the list of companies on these cases. And if you look at the second quadrant, talks about the quality of the business is so low and the pricing is also so low. It means this is a business being ignored by the market and the business doesn't deserve the market attention as well. So this is a company we should basically avoid because they don't encourage anything on this ground. But if you look at the third grid, which is like a quality of the business is high, okay, and if you look at the pricing which is high, which is very natural, because if a business is a very good, attractive, and it is highly appreciated by the market, which is natural that they tend to have a high pricing model. So let's see what are the companies matching there. But this company may not give much returns for someone who is actually planning to invest now, because it is already available at a high price. So we should have a plan when to actually acquire them. And if you look at the fourth one, which is like a quality business, the quality is very low, but the pricing is very high. Am I right? In a way that the fourth grid is the most dangerous grid. Am I right? Because it is a low quality businesses, but the pricing is extremely high. Murugan, does it really exist? Very naturally, it is available. By this time, many of you might have guessed it. Who knows, you may be right. Let's see how we can extract them using a screener.in. If you get into it, we are going to use this factor as a screening method, which is average return on capital employed for the last 3 years happens to be greater than 25%, because we are taking a greater than 25%. What does it mean by return on capital employed? How efficient that the business were able to make. If a business itself making more than 25% for the total capital employed, then it is seen as a one sign of a quality business. Okay. And the second factor is the market capitalization in a greater than 10,000 crores, just to ensure that we get the top companies which are more than 10,000 crores. So we were able to avoid the penny stocks having this particular list. And the price to earning ratio should be less than 20, in a way that we get a fairly affordable pricing structure. We consider that as a low pricing nature. Okay. Don't go to the pricing which is less than 5 or 10, then you, in a way that you tighten up the nozzle so tight in a way that you don't get a quality business. So be aware of that. The pricing, the P ratio what we take is less than 20. Let's see how to find them in the screener website. If you go to a screener website, and you can easily access them via screens, and we were able to create a new screen, and we copied the same thing called average return on capital employed for 3 years, 25, return on capital market capitalization greater than 10,000 crores, and price to earning is less than 20. In a way that if I run this query, I've got some companies which are like Castrol India, Coal India, Jindal Steel, Hindustan Zinc, right? Let's sort them using market cap. So we are getting this list like Hindustan Zinc, Coal India, Bajaj Auto, Aeronautical, NMDC, Petronet LNG, IGL, am I right? There are a lot of companies, Sun TV. So these are the companies are actually matching what grid? These companies are matching a grid called high quality business but a low pricing. Murugan, does it mean all of these companies are investable? We don't say immediately yes, but these companies are available at a fair price considering the quality of business. So we need to do little more detailed analysis because is there is anything wrong? Let's say if you take the Coal India, it is a high quality business because the return on capital employed is fairly good. But if you look at the pricing, which is low, the reason being is they're actually showing a very less growth. If you look at the last 10 years, the growth what it offered is low. So we need to do little more analysis. So in a way that I'm not saying immediately this is an investable business. But let's go to the next one. The quality of the business is low, but the pricing is also low. How do we find it? In a way that if you look at the quality of the business, the return on capital employed is less than 20%, and the market cap is greater than 10,000 crores, and the price to earning is less than 20. So how do I actually find it? So this is where you have to go to this particular grid, and we just copied this, and I'm going to run this query. Look at the company like National Aluminium, Tata Steel, DCM Shriram, and if I sort it based on market cap, and as I already told you that ignore banking from this perspective, and if you look at ONGC, NTPC, M&M, surprisingly M&M, and Tata Steel, Power Grid, Adani Power, these companies are having a fairly low valuation, no doubt about it. These companies are having a fairly low valuations. But the point is, they are not also a quality business. So probably we should avoid of these companies. I hope you got the list of companies. If you want to replicate the same, do attempt it using Screener website. Maybe it is freely accessible at this moment. You can try doing so. The other one is the quality business, high quality business, but the pricing is also high. The pricing is also high. So let's see how to find them. The point is their business average capital employed should be greater than 25 and the price to earning should be greater than 50 because we said the pricing should be, extremely high. So let's see the list of companies. So to find them, we are getting into this one again. The return on capital employed should be greater than 25 and price to earnings should be greater than 50. And the size again should be greater than 10,000 crores. If I run this particular query, I'm getting the list of companies. I'm again sorting them based on market cap to see some top names. Hindustan Unilever is one of the top company, high market cap, having a good quality business. Surprisingly, they are having a high PE ratio. So remember, these companies are really good companies, but they are available at a fairly high price. So we should figure out how to grab them. So by any chance, if there is a big crash in 2023, you should be waiting to grab these companies. But I don't say that there is a big crash expected. But if at all, if there is a crash in 2023, don't run behind the penny stocks. Don't run behind the stocks which are available in single or two digits. Rather look for a high quality companies, hardly approachable for us to buy. If they are becoming a low hanging fruit, go and grab them. But this is not a company I'm talking in a bonus tip. There's a one investable tip we got it. The one investable tip what we got some time back was actually matching in this particular grid. In fact, the tip I'm giving you is the name was actually visible when we had given. But remember, if you were able to get that particular stock, put it in the below comment section because at EQSIS, we actually offer people in terms of how to invest companies from a longer term perspective using systematic investment model. How? I think most of you must be aware of the point called EQSIS.com. And if you go there under app section called EQSIS Invest, and this is a platform by which we recommend people to invest list of companies from a longer term perspective. And this is a very interesting platform because at EQSIS, behind the screen, we do research and you at your end, you're investing. So this is a platform which connects a client to the research platform. So if you say that you want to invest monthly, let's say if you want to invest 25,000 rupees, and if you hit the start button and if you proceed further to subscribe this particular platform, you get the list of companies every month to invest from a longer term perspective. And the the question what we actually given you, guess the company which is really good to invest now. And the point is we added that particular company few months before in our list of portfolio. Let's go back to the original topic of this video, the most dangerous company. The most dangerous company is a company which you look at the quality is extremely low, because if you look at the return on capital employed for last 3 years is less than 15%, whereas the pricing, if you look at this, the pricing is extremely high. It means this company has shown a stellar move maybe last 3-4 years, but they don't deserve it because the quality of the business is quite doubtful. And especially this is true if you are planning to have a conservative long-term portfolio. So how do we plan it? Let's go back and see the screener what it says. And if you go back to the screener website, and we mentioned the same, the return on capital employed for the last 3 years should be less than 15%, and market cap around 10,000 crores more, and the price to earnings. Let me run this query. Most of you maybe must have guessed it already. Let's see the names. Bharti Airtel. Bharti Airtel, yes, true that because the track record shows that return on capital employed because of tough competitions, and it's actually on a lower side. And if you look at the pricing, which is slightly high because the stocks did really run up. And it may be quite surprising because Murugan, a few months before, when the stock was available at just 600 rupees, you made a point to buy this particular share. And based on which many of our customers have bought it, and they've already made close to 20%. But why are you now saying? Because at the current price, the valuation seems to be quite slightly expensive. But we don't deny the fact that the whole industry is into the emerging curve. So maybe it is a risky bet from a long-term investors from the multi-bagger perspective. But for 2023, it's too early at this moment. And look at the number 2, number 3, number 4, number 5, number 6. Adani Enterprises, Adani Green, Adani Transmissions are the companies maybe a nightmare for a lot of investors in the year 2023. Be aware of it, because these companies doesn't come up in the quality business, whereas on the other hand, the price to earning ratio is unjustifiably high. So the list of companies what you should definitely avoid is Adani Enterprises, Adani Green, Adani Transmission, especially for the year 2023, right? So I hope you got a fair idea in terms of how to do. But if you see that EQSIS can definitely add value for your long-term investment journey, consider joining us.